All right, welcome back. Let's move into the next section of commercial banking, chapters 16, 17, and 18, which are about bank lending. Okay? So believe it or not, the principal reason banks are issued charters is to make loans. Sometimes it doesn't feel that way. Sometimes it's really difficult to get a loan from a bank. But as we will see, there are some laws in place that help borrowers get loans from banks. Banks are in the business of making loans. Okay? Lenders are expected to supply credit for all legitimate business and consumer financial needs and to price that credit reasonably. Banks are in business to loan money. All right. Loans are important because they support the growth of new businesses and jobs within the lender's market area. That's why banks are so heavily regulated, is because they are so important to the economic health of their market area. All right, let's look at the types of loans. We've looked at this in a previous chapter. The largest category of loans in dollar volume is real estate. Banks loan money for people who want to build their homes, for developers who want to develop commercial property, for farmers who want to buy farmland and develop that farmland. The second largest category of lending is to individuals, and this is money that is loaned so that people can buy cars, mobile homes, boats, pay for education, pay for home repairs, medical expenses, vacations, things like that. Consumer lending. The third largest category of lending is commercial and industrial lending. And the reason why commercial and industrial is not larger than loans to individuals is because of the bond market. Companies borrow money directly from investors. They take the bank out of the equation through the bond market. Otherwise, C&I loans would be the largest type of loan. And banks are involved in loaning to business so that business can buy inventory, match up their cash flows for payroll, maybe buy or lease equipment. Okay? Then there's financial institution lending. That's one institution to another. And then agricultural lending, not for real estate purposes, but for planting, for buying seed, for harvesting, paying labor, for feeding livestock. These are expensive propositions, and as you know, there are times of the year when farms plant, and times when they harvest, and times when they sell their crops and collect their cash. And so cash flow does not match up, and that's where banks help. All right, and then there's lease financing, which is really kind of a form of commercial and industrial financing where the banks take title to the equipment and lease it back to the customer. All right, so this is a look at how banks lend, what bank lending loan portfolios look like, and so you can see that real estate is the largest by far component for small banks. Okay. And then you see loans to individuals, and not so much made by small banks, but the larger banks, a lot more individual lending, and then commercial and industrial lending about equal between small banks and large banks. Okay? But you can see how large real estate lending is compared to the other categories. All right, so what factors determine the mix of loans and the growth of a loan portfolio at a bank? The general rule is a lending institution should make the types of loans for which it is best suited. Okay, so what determines how a bank is situated to make loans? What are those key factors? Well, the first thing we look at is the market area served by the bank. Okay? Is the market area an urban area, a suburban area or a rural area? What are the mix of businesses in that market area? And what kind of natural resources are in that area that will help determine what kind of businesses you have? If you have a lot of farmland, it's going to be a rural agricultural area. If you have minerals, then there's going to be a lot of mining and extraction activity going on, those kinds of things, okay? So other than the market area, we also look at management. What is their experience in the banking industry? What is their expertise in putting together loans? What are their contacts, okay? And what is the risk appetite of management? How risky does management want to get with the loan portfolio? These things determine the loan portfolio of the bank, okay? Another key area of the bank that determines what the loan portfolio is going to look like is how much capital the bank has. That's how much stock that the stockholders put in, the contributed capital, and the retained earnings that the bank has, and what kind of deposit balances have they gone out and marketed in order to grow their funding. Okay? So what kind of capital does the bank have? What kind of yield is expected on each type of loan? Okay? If there is a really high spread on consumer lending, and those loans are available in the area, then management is going to go after that type of loan. Okay? Lastly, regulation is going to impact the makeup of the loan portfolio. Okay? And we'll take a look at these areas. All right, so speaking of regulation, let's take a look at regulation. So the mix of loans, the quality of the loans, and the yield of the loan portfolio are heavily influenced by regulation. So let's take a quick look. We've looked at some of these before, but let's revisit some of these regulations. First, the national regulators, the Office of the Comptroller of the Currency, or state commissions has some limits that they put on banks. Okay? The total volume of real estate loans made by a national bank cannot exceed the bank's capital or 70% of its total deposits. And so you could see that it was 55% nationally, 55% of the loan portfolio, which is going to be pretty close to the deposit portfolio. Okay? But there's a limit of 70%. Okay? Whichever is greater. All right? And 70% of the deposits is going to be much higher than the bank's capital, I can assure you. Okay? An unsecured loan to a single customer normally cannot exceed 15% of a national bank's capital. So these are regulations that are intended to help banks manage their risk. Okay? Some other laws that impact lending: the Community Reinvestment Act of '77. Lenders must make an affirmative effort. They have to go out there to determine who the individuals and businesses are in their territories, and they need to meet the credit needs of these borrowers. Just making sure that we're on and working, okay? So that no areas of the community are discriminated against when they're seeking access to credit. So this is one of those rules that if you have a legitimate business and you apply for a loan and you are turned down, you can go to the government and seek remedy for this. Okay? The Equal Credit Opportunity Act of 1974, another law that has to do with lending. No individual can be denied credit because of race, sex, religious affiliation, age, or receipt of public assistance. And so if you apply for a loan and you've got a job and good credit score and you've got some collateral and you're turned down, you can have an attorney look into whether that bank is treating you fairly or not. This one has to do with international lending, and this is where banks have to make the public aware of any credit exposure that they might have. And again, this goes back to the 70s and 80s when U.S. banks were loaning a lot of money into Central and South America. So we don't see this act coming up very often, particularly in state banks. All right, but again, there's some disclosure that has to happen and some limits on how much can be loaned into those countries. All right. All loans that are made are subject to examination. Okay? Got to make sure that the banks are playing by the rules. Okay? And so regulators use this thing called the Uniform Financial Institutions Rating System. Okay? And they score the bank's asset portfolio, which is their loan portfolio. Okay? And so this is what examiners look at, and these are their scores. Strong performance, satisfactory, fair, marginal, unsatisfactory. Okay? Now, the definitions or the qualifications that goes into each of these are not specified in the book. So I'm not sure. I have to do a little bit of research on my own to determine what goes into each of these ratings. In fact, let me say that if any of you want to write a short paper on these ratings, how the examiners come up with these ratings, then I'll give you credit. I'll give you a significant amount of credit, as much credit as you would get on a test if you want to write a paper. So let me know if you want to do that. All right, loan quality classifications. So once again, these are terms that the regulators use. Criticized loans. These loans are performing, but they are either outside of the loan policy, they do not fit in with your loan policy, or they are not fully documented in your file. So again, it's about keeping a good file. A scheduled loan has significant weakness, meaning there are warning signs that indicate that the borrower is in trouble, or there may be dangerous concentration, too much of the bank's loan portfolio in a certain company or in a certain industry. Okay? Adversely classified means that there's an immediate risk of the loan not paying. Okay? Substandard loans means that the collateral or the ability of the bank, of the customer to repay is not very strong. And then doubtful loans, very similar definition there. Finally, there's loss loans, and these loans are loans that have already been determined to be uncollectible. So you're going to have an internal auditor that's going to go through, and then you're going to have an external examiner who's going to go through and classify loans. Okay? All right, the last rating system we'll look at is called the Comm's rating system. Okay? It's an acronym. Okay? So 6 areas of the bank are combined into one rating. Does the bank have adequate capital? Is the loan and security portfolio of good quality? Does management have years of experience and expertise? What does the earnings record look like at the bank? How liquid is the bank? Okay. What happens if a major employer in the market area were to shut down? Okay. And note that institutions with low ratings are examined more frequently than institutions with high ratings. All right, last slide in this section has to do with establishing a good loan policy. So every bank must have a good written loan policy. And so the first thing you have to do is explain to the commercial lenders and the consumer lenders what their goals are for the whole portfolio. Each lender, each officer is going to have authority in a dollar amount that they can loan without kicking it upstairs to the loan committee. Okay? Then there's going to be lines of responsibility handed out to each of the commercial lenders as to where their territories are, maybe what their industries are, and the reports that they are supposed to maintain. Okay? So if you're a commercial lender, then you're responsible to maintain the files. You're responsible to get out there and contact the businesses in your area to let them know that you want to loan money to them. Okay? Then now the management has to develop procedures for soliciting loans, for evaluating loans, and for making loans. And you create a set of standards that you apply to all loans. You do not discriminate. All loans have to pass these quality standards. Okay? There needs to be guidelines for evaluating collateral. How good is collateral? And there needs to be procedures set up for taking collateral. And customers need to understand that. Okay? Lastly, there needs to be procedures to detect and to work out problem loans. So all of these things are written in a book, a set of guidelines for all lenders to be aware of and to follow and stick to. All right, that's it for the first half of chapter 16. Let's take a quick break and we'll come back and work on the second half of the chapter. Peace out. Shalom.